$12 billion of one-way options demand walked into the S&P today and left almost no mark on price. That is not a figure of speech. Net options delta across the cash index finished about positive $12 billion, built from put selling and call buying together, the strongest one-directional reading in roughly a month. What it bought was a close at 7,652.86, down 21.5 points, 0.6% off the session high, inside a range of 42 basis points. This is your market close from Algo Index, Monday the 24th of August. The Volatility Index finished at 15.85, up 4.75%. Tonight we will settle where the $12 billion was aimed, why the day never reached either position that framed it, and the one trade flagged before the opening bell that paid by the close. Start with the surface. The S&P closed at 7,652.86, lower by 0.28%. The Nasdaq 100 closed near 29,023, lower by 0.97%, more than 3 times the loss. That gap is the day. The memory group fell about 5.9%, semiconductors about 3%, and the wider technology group about 1%, while financials added roughly 1% and consumer staples about 2%. Money did not leave equities today. It changed seats inside them. The Volatility Index at 15.85, with volatility of volatility up 3% to 88.64, tells you protection got a little more expensive on a day the market barely moved. Implied volatility at 12.79 sits close to realized volatility at 12.14, with an implied volatility rank of 13.6%. Here is a measurement worth keeping. At 7 this morning, before a single share traded, the same-day straddle on the index was quoted at 25.6 points against a reference of 7,665. That is the market pricing its own expected absolute movement for the session. The index closed 21.5 points from Friday's settle. The pre-open quote described the delivered move very closely. Set that against the wider expected daily move of 0.63% and a delivered range of 0.419%, and the session produced about 2/3 of what was priced. Nothing broke, and the options market had already described how contained the session could be. 3 things moved this session, and only one was obvious from price alone. First, the chips. The semiconductor group fell about 3% and the memory names about 6%, 2 days before the sector's quarterly report. Nvidia dropped roughly 3% for a 7th consecutive losing session, its longest run of declines since 2022. Tesla fell about 4%. Second, the rotation absorbed it. Financials gained about 1% and staples about 2%. This was a reallocation inside equities. Third is what price could not show. Net index options delta did not arrive smoothly. At 9:42, the reading sat at negative $834 million, its low of the day, right as the index was forming its bottom. It turned positive by 10, moved past $3.3 billion by 10:35, reached $6.7 billion shortly after 2, and finished near $12 billion. That is a swing of almost $13 billion in one direction, across a session that closed 21 points lower. The composition explains the gap. The majority of the demand expires within days. Buyers were renting exposure into Wednesday, not accumulating a lasting position in this session. The intraday record here is genuine. Our archive holds all 78 5-minute bars from the regular session. Price opened near 7,663 and lost about 25 points in the first 20 minutes, printing 7,638.17 at 9:50. That was the low. From there, a 3-hour recovery carried the index to 7,670.30 at 12:25, the high of the day. Price gave back to 7,648.84 around 1, pushed once more to 7,668.86 just after 2, failed again in almost the same area, and settled at 7,652.86. Now place the structure on top. The dealer gamma flip sat at 7,629. The low stopped about 9 points above it. The volatility inflection level sat at 7,700. The high stopped about 30 points below it. The whole session stayed between about 13,000 dealer long calls at 7,600 and about 20,000 dealer short calls at 7,700. Price reached neither strike. Dealer gamma positioning finished positive across all 3 published measures, the type of positioning that dampens moves rather than accelerating them. The demand was real. the price says those buyers have not been paid yet. This is the position to remember. Before the opening bell, the positioning report carried 20,000 small-cap 297 puts, expiring August 31st, bought to open. Behind them sat 46,000 September 285 puts and 30,000 September 283 puts. The same direction and dated further out. Small caps fell 0.7% today. Those three strikes gained about 20%, 13%, and 16%. A move of well under 1% in the underlying added roughly 1/5 to the lead position's value, because the downside cover was bought before the move. The same report flagged about 4,000 semiconductor 535 puts. The fund fell 2.4%, and those puts gained about 13. It closed near 547, 2 points above its key gamma strike at 545, while weekly implied volatility rose across the board. Hold both halves together. About positive $12 billion of same-day upside demand in the index, and dated downside cover in small caps and semiconductors, already paying. That describes a market optimistic about the next few hours and protected against the next few days. A quick volatility read. Implied volatility sits at 12.79 against 12.14 realized, and the implied volatility rank is 13.6%. The price of optionality is near the low end of its 12-month range. Direction has already turned, though. Fixed strike volatility rose 2 to 4 points across this week's expirations today. Cheap in level and rising in direction, 2 days before the monthly inflation reading and the chip earnings that the sector is positioned around. The question is, which of those facts matters more for anything carried through Wednesday? One position filled today, and it worked. The long went on at 7,670.25 just after 10 in the morning. Shortly after the opening decline was absorbed and the options flow turned sharply. Price pulled back to 7,663.50 within minutes, retested the area, and sat close to entry while the clock ran. It reached the 7,680 target at 11:45 for an exit at 7,678.50. 1 win, 0 losses, and the book was flat by the close. 3 other setups were staged, and none filled. 2 never traded to their entry, 1 was retired at the cutoff. A setup that never activates costs nothing. We grade the full plan, not only the fills. Look back before looking forward. Friday, the risk name for today was energy through the Iran headline, on the reasoning that it could raise oil and reopen inflation concerns. The announcement arrived. Crude fell 2.35% to just above $85. The inflation concern did not return. The damage came from semiconductors instead. The energy red was wrong today. For Tuesday, consumer confidence and new home sales arrive at 10 in the morning, followed by a 2-year note auction at 1. The pivot at 7,650, about 3 points under tonight's close, separates the constructive case from the defensive one. Above it, the first near-market strike is 7,667, followed by the nearest expiry magnet at 7,675. Below it, 7,644, then the dealer flip at 7,629. A sustained break below that flip can make hedging amplify price movement. Tuesday is a waiting room for Wednesday's inflation reading in the morning and Nvidia earnings after the close. The policy symposium opens Thursday. This show names the dealer levels before the session tests them, then grades each one against the printed result. Today, the flip at 7,629 and the inflection at 7,700 both shaped the session without price reaching either. The public graded history is at algoindex.com/tools/gamma-level-accuracy. The largest one-way demand in roughly a month arrived today and bought a 21-point decline because it was aimed beyond today. I will see you after Tuesday's bell.